Imagine a company with zero debt, over 1.1 billion Hong Kong dollars in cash, and a dividend yield north of 6%. Now imagine that same company trading at a P of just 10. This isn't fiction. This is Valuetronics Holdings, quietly powering your everyday tech from the shadows. Is this Singapore's most overlooked dividend stock? Hey investors, welcome to Durian Finance, where we slice through the noise to give you clear and concise insights into Southeast Asia's hidden stock gems. Today, we're diving into Valuetronics ticker symbol BN2 as an electronics manufacturer that's weathered supply chain storms, diversified its base, and is now sitting on a pile of cash. We'll walk through their FY 2024 numbers, what's behind their margin boost, and whether it's worth a place in your dividend portfolio. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial advice or a recommendation to buy or sell any securities. Always do your own research and consult a licensed financial advisor before investing. Let's begin with the numbers. Revenue in FY 2024 fell 17.1% to 1.67 billion Hong Kong dollars. Not great, right? But here's the twist. Net profit actually rose 29.8% to 159.6 million Hong Kong dollars. How? Legacy customer exits. Key CE and ICE clients shifted production out of China due to tariffs and geopolitical concerns. CE dropped 17.6%. ICE plunged 23%. Weak end market demand. Continued softness in consumer electronics and printer hardware inventory correction further pulled revenue down. But new clients are stepping in. Their Vietnam plant is now serving networking, theme park, retail tag, and liquid cooling customers. Starting contributions in H2 FY24 and expected to accelerate in FY25. So yes, top line fell, but Valuetronics rebalanced its customer base, lifted gross margins via cost relief, and turned that challenge into a net profit surge. Would you invest in a company with falling revenue if its profits and margins are improving? Drop your thoughts in the comments. So what exactly does Valuetronics do? They manufacture consumer electronics and industrial and commercial electronics. Recent wins include a CE client tied to a global entertainment giant, an ICE client in network access solutions. They also launched new product lines tied to cooling systems for high-performance computing and retail chain hardware. Production is split across China and Vietnam, giving them flexibility amid U.S.-China tensions. Their Vietnam campus, opened in 2022, has already conducted full new product introductions (NPIs), a major milestone for speed to market. Smart manufacturing control, using MES dashboards, lets them optimize real-time operations across campuses. Let's talk dividends, because here's where things get exciting. FY 2024 dividend, 25 cents per share, boosting the total payout to 25 Hong Kong dollar cents. This equates to a payout ratio of 64% against net profit. At the current share price of 69 cents, that delivers a dividend yield of 6.3% plus. Valuation and financial health metrics. Gross profit margin, 15.9%, up from 13%. Net profit margin, 9.6%, reflecting continued profitability. EBITDA, 219.5 million Hong Kong dollars TTM, with an EV/EBITDA multiple of just 2.84 times. Total cash per share, 2 Hong Kong dollars and 67 cents, with no debt, yielding a current ratio of 2.32 times. Debt to equity ratio, effectively zero, given no borrowings reported. In addition to dividends, they kicked off a 250 million Hong Kong dollars share buyback program in February 2022. So far, they've repurchased 26 million shares, HK $79 million. Would you prefer a well-capitalized, high-yield cash generator like this, or go for high growth but riskier stocks in this macro environment? Comment below. Let's look at Valuetronics' strategic growth plans. First, their FY 2024 annual report highlights planned greenfield expansions. They're aiming to build new facilities to drive long-term organic growth. But here's the headline. Valuetronics has stepped into AI with a 55% JV called TrioAI in Hong Kong. They're collaborating with Senate Cloud to offer GPU-powered AI cloud services, starting with a 7.7 million Hong Kong dollars equity stake and equipping the JV with up to 60 million Hong Kong dollars in leased server hardware. And to power this future, they're investing about 172 million Hong Kong dollars in GPU chips and infrastructure, clearly signaling a pivot beyond just contract manufacturing. Now, what are red flags? Revenue has been in decline, especially in their IC segment. Levered free cash flow turned negative in FI 2024, possibly due to capex in Vietnam. Yet, the management outlook is optimistic. Diversified client base, Vietnam ramp-up, strategic cash use for organic and M&A growth. They've proven prudent. Despite headwinds, net profit keeps growing and they remain debt-free. So what's the final verdict? Valuetronics is not your typical tech stock. It doesn't scream disruption. It whispers resilience, stability, and value. If you want exposure to Asia's manufacturing strength, global tech clients, and a reliable dividend play, this one's worth a look. Would you add Valuetronics to your dividend portfolio, or are you waiting for stronger top-line growth? If you found value in this video, give us a like. Comment below, are you team dividend or team growth? Subscribe to Durian Finance for more clear-eyed SGX stock insights. Thanks for watching, and remember, boring businesses can bring beautiful returns.